Well, folks, what an absolutely wild week it has been. Lots of things have changed in this market from a technical perspective, and quite rapidly, might I add. It's worth assessing exactly what has changed and exactly how much it has changed. That's what we'll do in today's episode of the Weekly Watchlist. Of course, anything that we're associated with is linked down below in the description. Quick thumbs up before we get started is a great way to support the channel, and stay tuned until the very end of today's video. I've got 2 additional trade ideas to share with you. With all of that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got a nasty, solid red-bodied bar with very minimal upper wick and very minimal lower wick as well. And of course, an extremely weak close at the lows of the trading range. So quite clearly, sellers are in control from a structural perspective, which is the exact opposite of the bullish hammer that we were discussing in last week's episode. So change number 1, clearly bearish. If we think about location on the bar-to-bar count, we did technically produce a higher high, but a more meaningful lower low, and of course we've closed as well underneath the prior bar's low. So location, once again, does stack up as a bearish change here, and the higher high is certainly noteworthy because we know that the buyers technically should have responded to a break over a hammer high and seen continuation in the upward direction if we were going to confirm the reversal that started to show itself in that lower wick. Obviously, that was not the case, and we have ourselves a bearish engulfer. So structure and location are both bearish. Now, in last week's episode, we also discussed that the back test of the resistance trendline and the hammer lower wick forming off of it was a bullish area of support. Obviously, we're back down underneath that. If we think about our support trendline here, we were holding up there. This was confluence of support. Obviously, we have closed now underneath that. If we take out our Fibonacci's from the low of this move to the top of this move, in last week's episode, we said, hey, we're holding on to the 38.2, which technically represents bullish consolidation. Obviously, we have failed to hold on to that as well, and we've also closed underneath our weekly 50 SMA. So all of the bullish data points that we discussed in last week's episode have failed, and we are underneath all of these areas of support. If we take a look at our anchored VWAPs, which we have anchored to the all-time high and the low from October, let's clear up that Fibonacci there. We violated the support VWAP, which of course was our lower VWAP, where the lower wick was from the hammer candle, and we've rejected the upper VWAP, which is coming from the anchor at the all-time high. This also strikes me as a bearish development, obviously in the downward direction. From a structural perspective, you'll recall also that we were very, very mindful of 390 being prior support, resistance, support, resistance in the upper wick, resistance, support, very, very technically well-respected level, and we formed that lower wick right above that area. Obviously, we have closed underneath as of Friday at 4 p.m. I'd also like to show you our high volume node, which of course was 390. It was that structural element. We have closed underneath that at this point in time, which does strike me as a bearish development. Now, before we get way head over heels about the market going to zero and being bearish and looking for a massive breakdown, I do want to remind you that the trend could technically find still a higher low, just not at an ideal location. We have lows, we have higher lows. There's still the opportunity, if we get a sharp reversal and hold early on in the week, for a weekly higher low. And then of course, it's all about, do we find a lower high and threaten a head and shoulders pattern? Of course, you could start to see left shoulder, head, and this of course would form our right shoulder on some kind of lower high that would be underneath the highs of late January, early February, right? So that's the risk of the weekly time frame chart. There have been some significant developments in the downward direction. However, is the uptrend jeopardized in full yet? Not yet. There is still some, be it small, be it large, there is some probability of a higher low holding here and looking for a reversal in the upward direction. Once again, then the threat would be, do we find a lower high for the head and shoulders pattern? Moving down to the daily time frame chart, let's first evaluate the weekly expected move. If you're not familiar with this study, there's a tutorial in the top right-hand corner for you. If we're contained by the upper edge of the weekly expected move, the number is 397.77, and that of course would imply a lower high from here to here, which is bearish. If we're contained by the lower edge of the weekly expected move, the number is 374.08. Once again, that's quite clearly just a big lower low. What's most important about this lower portion of the expected move is the suggestion that we will be getting some price acceptance inside of the balance range from the December session, which of course is a step in the downward direction if we're thinking about balance ranges and where the progress is being made. So quite clear here that expected move is undoubtedly bearish. Now, what else is bearish? The daily trend is still down with highs, lower highs, the suggestion of a lower high here. But most importantly, we have lows, lower lows, and we just made a big new lower low. So noting the way that we get involved in downtrends is on lower highs or equal low breakdowns. Do you want to be a big new money short sitting here at the worst possible trade location? Probably not. At this point in time, it doesn't seem unreasonable that the market gives us a little bit of a counter trend rally, call it a dead cat bounce, whatever you want, and then we reverse in the downward direction. It's your job to find the lower high or wait patiently for the equal low breakdown if you think we're going to go back down to the equal lows on the weekly chart closer to 375.50. So that's what we've got from a trend perspective. In terms of analyzing our levels and what's going on here, we've of course rejected the overhead balance that was Monday's session here, and we've also violated the most recent balance, which was here. Recall that we had a look below and fail, look above and fail, and now obviously we are underneath those lows at 393.50. That means that going forward, 393.50 is your key resistance. If you're looking for a lower high, it wants to form underneath 393.50 to keep this overhead supply rejecting for a break, retest, and then continuation. We could also say that we have clearly failed the daily 50 SMA. We have failed our daily 200 SMA. That, of course, does strike me as more bearish than bullish. If we take out our Fibonacci's from a more nuanced perspective, this is not the same range as the weekly. We are underneath the 61.8 fib, which we were holding early on in, or I should say in the late stages of 2 weeks ago. That was holding as support. Obviously, we are underneath that now, which dramatically increases the odds that we do ultimately see a 100% retracement. We are also, if we take out our anchored VWAPs from the daily perspective, all the ones that are anchored from the bottom onward, we're underneath this VWAP band, as we've been calling it in the last video. So the fact that everyone now, the quote-unquote average buyer since the bottom in October, is now underwater does strike me as being, once again, more bearish than bullish. So all of these bearish developments are significant, but I would just remind you one more time that because we did just produce a big-time lower low, it wouldn't be unreasonable to see a counter trend type rally for a dead cat bounce, and once again, your job is to spot the lower high underneath 393.50. Now, in the downward direction, what's key support? Obviously, it's just the bottom of the December range, right? If we're going to make a weekly equal low, fine, the weekly trend is neutral. It is no longer, offering up a higher low, and that means that this needs to hold, right? 379. If that does not hold, kiss this thing goodbye. Weekly trend flips back to down, and we're looking for more bearish outcomes, equal lows, starting to jeopardize what was put into place so far, and the more constructive rally that we've been discussing off of the October lows here with the give and take, right? Take, give, take, so on and so forth. That all goes out the window if we start failing underneath 379. So that's the big concern as we move forward into the coming weeks worth of trade. If we go on down to an hourly time frame chart, let's just briefly discuss, right? This, of course, was a fundamentally driven move, and we'll talk about the whole collapse of SVB when we get into the fundamental take for our markets. But of course, support isn't really going to hold when you're seeing a fundamentally driven move in the market. Now, one thing I do find very interesting is that this was the balance area, right, on the daily. Friday morning, we saw a rejection of that balance. So what does that tell you? Well, from a psychological perspective, anyone who was long from this area in here wanted to get out as close as possible to break even, and the fact that they sold it there does strike me as being more bearish than bullish. Nobody really wants to be long as this breakdown was taking place, and this is kind of evidence for that. So just to summarize here, a couple of scenarios, right? It's reasonable that we get a counter trend rally. Obviously, we want to see lower highs at or underneath 393.50, and if we're a bear and we just see continuation in the downward direction, or if you're a bear and you just see downward continuation here, it wouldn't be unreasonable to see a dead cat bounce off of 379. Those are really the two major areas that I would focus on into the coming weeks worth of trade. Let's take a look at some supporting evidence now. First up are the market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. Very simple. Our net outflows for the week are very significant, coming in at 1.8 billion. That's one of the larger reads I've ever seen. And by the way, this indicator is available now on our website. Check out the link down below in the description. Trading-scripts is the extension there. The advanced decline line, of course, all bearish throughout the majority of the week. Some slight concerns about overcorrelation into the end of day on on Friday, which once again could lead to the start of a dead cat bounce. But overall, it's just that. It's not a full trend reversal in our ES, just a dead cat bounce based on the overcorrelation there. And of course, the cumulative builds are all substantial in the downward direction. One thing I do find interesting is that as the little confusion was taking place early on in the Friday session, here's that little back and forth right before the flush, notice that it keeps the cumulative build from really getting as aggressive as what took place on Thursday. So once again, if you see on Monday, for example, this lesson once again, it starts to indicate, hey, sellers, they're kind of out of bullets off of these lows. The trend's not going to reverse, but there's certainly the opportunity for a dead cat bounce. But overall, sellers do have the momentum. Next up is the market profile. If you're not familiar with this one, video tutorial in the top right-hand corner. The profile really did its job on the high, the 40-20 high that we called out in the Wednesday update. If you didn't watch Wednesday's video, it's kind of unfortunate. It only got about half the viewership of the Sunday video. We talked explicitly about 40-20. Market profile gave us that level and it worked to the T. Now, was anybody expecting this? Absolutely not, but we were looking for lower highs off of that area. As we move forward, there's not much to glean from the profile other than the fact that yes, value did move definitively lower on Friday with the point of control. If you have the 415 close for futures on, you would notice that Thursday's point of control and value would be lower as well. This really boils down to a timing issue. The tape was moving so fast that there really wasn't enough time spent at each price level lower to build value in the downward direction. Of course, unless you have that 415 close, which usually just ends up going sideways, very lackluster in the last 15-minute extended period for futures. So overall, value is lower. It's confirming the sell as of right now, and we are rejecting these overhead levels, right? This was really where the market profile shined. Now we're being patient, waiting for that next nuance to develop. We have good highs and good lows here in terms of excess. Nothing crazy to talk about from a profile perspective. Moving back on over to Thinkorswim to evaluate the weekly performance of our sectors, it's no surprise that financials are at the bottom of the barrel, down a whopping 8.55%. Huge cause for concern, noting that this is the third heaviest weighted sector in the S&P 500. At the top of the list are both of our defensive asset classes, so consumer staples and utilities, taking less of a hit, but still red nonetheless. Then interestingly enough, tech is also up here towards the top of the list. Only, it feels weird saying only, but only down 3.75%. Let's check in on the structural charts and see what's going on from a trend perspective. Overall, XLP basically made an equal low in an overall downtrend. I wouldn't be surprised to see a breakdown here and then look for support around 70.20. That of course is bearish for the S&P, and even if it bounces, forms a double bottom here and starts to outperform over 72 with a higher low. Recall that from a posturing perspective, this is D for defensive. Wouldn't really speak to highly favorable outcomes in the S&P if a bottom is being led by consumer staples. So no way out of this one. Definitely strikes me as more bearish than bullish. Same thing with utilities. It's literally the exact same idea. Overall downtrend, wouldn't be surprised to see the equal low breakdown here into the next support at 62. If it does start to outperform and get some sideways activity, higher low above 65, D for defensive posture steps in and says, hey, probably not all that favorable of a bottom forming in the S&P 500. Next up, though, is the XLK tech sector. And this is really what's fueling the idea, for me at least, that, hey, be open to the idea of possibly a dead cat bounce early on in the week. Why do I say that? 100% retracement right back down into the equal low here and daily 50 SMA. That's the blue moving average. If we see a dead cat bounce, being the heaviest weighted sector for the S&Ps, I wouldn't be surprised to see that ripple over to the SPY itself. And then if we find a lower high underneath 139.25, that's where we say, okay, great. Now we've got a descending triangle. 135 turns into a flush point, looking for bearish outcomes when and if that level breaks. So really focusing on the interactions of 135 and 139.25 in the XLK in the early stages of this upcoming week. Next up, healthcare sector. Let me show you this on a monthly time frame chart, just so you're aware from a context perspective that we're sitting at the bottom of an overall balance range once again on a 100% retracement. Would it be unreasonable for a dead cat bounce and lower high and then break? You know, sure, that technically could happen. I just want you to be mindful that, hey, healthcare technically has a pretty strong area of support that we're coming into around this 125 down to 121.50-ish zone. You know, if it breaks down, we'll call a spade, and the next, logical area for this to move is closer to 110, this break, retest, and rally area. But for now, at least open to the idea that, hey, if we start to see buyers step in around here, look for that dead cat bounce. Going back on down to the daily time frame chart, doesn't appear as though it's going to happen early on in the week with this upper wick rejecting the Thursday range, and again, a fairly weak close on Friday underneath 125. So still maintaining a bearish edge in the second heaviest weighted sector for the S&P 500 here, but just being open to the idea idea of turbulence here as a support zone on the higher time frames. Next up is the XLI. What's going on with industrial? Certainly breaking down from its ascending triangle here. This does strike me as bearish. Strong opportunity for a lower high underneath $100.50 now, which is not bullish by any stretch of the imagination. Energy, once again, is a D for defensive asset class. So even if it bounces here and stays in the range, from a leadership perspective, not ideal if you're trying to be a market bull. If we get a breakdown here, downward pressure is downward pressure. Next up is the XLC. Big retest on the weekly time frame chart. Recall that this is a balance area break. Retest, is it going to hold on the weekly time frame chart, is a big question early on in the coming weeks worth of trade. Really watching to see how 52 as a zone resolves. If we get the bounce off of it, maybe it keeps the markets neutral early on in the week, but if we find a lower high under 54.30, that's where you look for this to break on the reattempt. That, of course, is your bearish outcome. Next up is the XLY in the midpoint of this previous range here. Of course, breaking down for the lower low, looking for lower highs. I mean, this is a bearish chart. There's no way around it. This is, of course, not helpful for the bull case in the S&P 500 at this point in time. XLB materials, really lightweight sector. This was the range that we were really focused on. The breakdown of 79 does strike me as significant. Key support is obviously now at 77.15 if it goes. More bearish pressure if it starts to bounce. It's really not going to save the S&P. Really lightweight sector there. Real estate also strikes me as being more bearish than bullish from a wealth effect perspective. Now, this was the neutral balance area. Looking for just kind of sideways outcomes in here. The fact that we're pushing new lower lows is significant. And once again, more of a bearish implication here. And the big daddy, here you go, financials. Big breakdown off of the head and shoulders pattern. We talked about this. Of course, the target was here. We were not expecting a massive flush like this under 34.50. Anyone who told you that they knew this move was coming, don't even get me started on that. But for the most part, this is a bearish chart, right? There's not really any recovery from a structural perspective at this point that it's just, hey, bullish outcomes are back on the table, right? Maybe we get a dead cat bounce, but there's a strong opportunity of big lower highs to be found anywhere underneath 34.50 at this point in time, which again is a concern, noting that this is the third heaviest weighted sector for your S&P 500. Note also on the left-hand side, as this breakout was happening here, we've got thin structure. There's not a whole lot of support. There's actually a gap unfilled in here that could come down and be tested closer to 32. And of course, next support is at 31.25. Nothing about this chart is saying, hey, buckle in and we're riding this thing back up to the moon. Maybe once again, a dead cat bounce, but more meaningful bullish outcomes really require better structure back above 34.50, back in this chop zone up here. Doesn't seem likely unless there's a massive sharp reversal on Monday. Comes out that, hey, the Fed's going to bail out, Silicon Valley Bank. Everything's fine, right? They've already sort of announced that they're not going to do that. We're not going to speculate too much on that, but structurally here, hopefully you can get the sense that some significant damage has been done. So dead cat bounce early in the week, maybe, but structure isn't all that great. Looking for lower highs underneath 34.50. Here's the ratio grid so we can visualize leadership. If you don't know how to set it up, there's a tutorial in the top right-hand corner. Overall, the top 4 risk-on sectors still, for the most part, look okay, barring the huge issue in financials, right? The tech sector looks great, just found a higher high in the ratio. And I would also add, if we go to a weekly time frame chart, it's still well above the resistance trendline break, which is here. So that does strike me as more of a risk-on type look in the tech sector. Keep in mind that this is a weekly chart. The XLV is trying to find a bit of a bottom. As we know, we're coming into the bottom of the monthly balance range, and the XLY is not accelerating in the downward direction. It's trying to find some support here around an upward sloping 50 SMA. It's really the isolated issue with financials at this point in time, which, again, don't get me wrong, this is a big issue for the markets, but from a risk-on perspective, everything else out there is kind of doing okay at this point in time. This is a bad apple, really weighing down on the S&Ps clearly. In terms of risk off, it's starting to creep slowly back into the picture, which makes total sense given that this is taking place here. Consumer staples finding a higher low and getting into that 50 SMA, noting that we are getting a double bottom out of the XLU again, back up towards the neckline in this area, and the energy sector is also sideways off of its lows and the double bottom from back in here. Real estate obviously getting hit with the implications for rates there, but risk off is creeping back into the picture. Risk on is only really deteriorating in the financial sector. Other than that, it's pretty tough to say. Like, if financials have a sharp rebound in the coming weeks worth of trade, it's not all that bad here on the ratio perspective. If we take a look at the XLY over XLP, so growth versus value, notice also that although yes, it is moving lower, it's doing so in a respectful manner. It's not accelerating like what we we had here or like what we had in here, and it's coming into that upward sloping 50 SMA, and it's still above our breakdown point from in here. There's the potential for a higher low to be found. So that way we have lows, higher lows, looking for the equal high and then a break over 2.1 to continue more of a bullish risk on type sentiment for the market. Now, it hasn't done it yet, and we're open to the idea if more of this fear and panic starts spreading throughout the market, if this breaks down, what'll that tell us? Obviously, it's a big indication that, hey, dial it back with the bullish sentiment from a risk on versus risk off perspective. So we're open to these ideas, but trying to weigh the data points accordingly. No big deterioration here yet. Moving over to the Dixie, obviously we've seen the break in inverted correlation between the dollar and equities here with the fear and panic from Thursday and Friday specifically. I don't want to speculate on how this potentially resolves, but just bear in mind that overall, the inverted head and shoulders is still very much in play as long as we're above 103.50. If we start to take out these highs around 105, in theory, it should put some downward pressure on equities. But once again, it's worth waiting to see how the dust settles before trying to draw any conclusions about the dollar and equities. While we're at it, let's take a look at the TNX. We're going to skip gold on today's session. TNX obviously falling off of a cliff here with the implications that, hey, Fed, you're breaking things as you continue to raise rates here. The TNX coming in, of course, would be a suggestion to say, hey, probably take it easy in the next meeting. Let's take a look at the Fed tracker tool, what's going on from a fundamental perspective. So on day one of Jerome Powell's testimony, he clearly acknowledged that the terminal rate will likely have to be much higher than originally anticipated, and that the Fed would be willing to reevaluate the pace of rate hikes if the data suggested to do so, therefore moving between a 25 and 50 basis point increment. These mixed messages from the Fed have been being reflected in the Fed tracker tool. You can clearly see the uncertainty flip-flopping back and forth between 25 basis points and 50 basis points up next. The market's likely going to continue to flip-flop back and forth as we're scheduled to get CPI, PPI, retail sales, and inflation expectations in the coming weeks worth of trade. With the uncertainty in the size of the rate hike and the uncertainty in the data that's set to come out, the only thing that I'm personally certain of is that we're going to continue to see extremely volatile markets until we get some clarity from the Fed and what is going to happen next. The saying typically goes that the Fed will hike rates until something breaks, and obviously Silicon Valley Bank exploding on the Thursday and Friday session is something breaking and in a substantial way. So this is technically providing positive feedback to the Fed that what they're doing with their hiking campaign is ultimately working. Now, at what cost? That's a different conversation for a different time. I'm not here to speculate on that. What happened with Silicon Valley Bank is that as the Fed raised rates, their mortgage-backed security portfolio declined in value. People ultimately wanted out. They were getting nervous about their funds there. Peter Thiel's note to bail certainly didn't help by any stretch of the imagination, and the bank had to sell these assets at a loss to get folks their money. The bank kind of imploded after that, right? Couldn't handle those losses. It was, regulators stepped in and shut the thing down. Kind of think of it like a huge margin call, but the depositors are the brokers. Now, the Fed will likely have to intervene and do something, but Yellen has already committed to not explicitly giving a bailout. Once again, I don't want to speculate on what happens after this. We're just noting that this is a positive feedback indication to the Fed that the rate hikes are technically working. Things are starting to break, which is kind of a sign that we're closer to the end of this cycle as opposed to the beginning. What else is a sign that things are quote unquote working? Well, unemployment did technically tick higher on the Friday session, but not by a substantial margin. It's still relatively low and underneath a 12 SMA. When and if we break the 12 SMA, it's usually where you start to see those big spikes. Hourly earnings also ticked lower underneath that expectation by 0.1%. So we're not really fearful of a wage price spiral at this point in time. So the market sees that as a good sign to tame inflation. However, on the back end is obviously concerned about the implications for a recession and corporate earnings down the line. None of this has anything to do with what we should do on the Monday session at 9:30. Speaks to the overall narrative that's taking place right now that we're probably closer to the end of the rate hike cycle as opposed to the beginning. How far, how close, how whatever, that's not the conversation. Just saying that we're probably past the 50% mark towards the end, not the beginning. Could more things break? Absolutely. Do we know what's going to happen with the bank? Absolutely not. We're not here to speculate on that. This is just positive feedback to the Fed that, hey, probably want to start slowing things down, otherwise you risk breaking more and causing more hardship in the short term. The flight to safety trade is 100% back on the table as the TLT has rapidly outperformed the S&P 500 here, which makes total sense given what we just covered. There's lots of fear, there's lots of uncertainty. Now we're seeing that classic flight to safety return here. This is a risk-off indication for our market. Let's take a look at the HYG and what's going on with junk bonds, so to speak. There's an interesting divergence here, noting that the equities market technically made a massive new low lower low here, whereas the HYG is just going sideways. So a bit of a divergence saying maybe this is a bit of an overblown reaction out of the equities market. It would sort of signal to be open to the idea of a dead cat bounce early on in the coming weeks worth of trade. That's the takeaway from this particular chart. Next up, let's have a look at the Bitcoin chart finally giving up and breaking down underneath 21.5K. This was kind of the spur for Silvergate Capital, obviously, which rippled over into the whole Silicon Valley Bank thing. So this does strike me as more of a risk-off implication for our market. Most of our breadth indications are also fairly bearish, with a big deterioration underneath the zero line here in new highs versus lows. You can see that the threat is obviously morphing into something more similar to what we experienced in 2022, which of course is bearish. If we take a look at stocks trading above their 200 SMA in the S&P 500, this ratio has ultimately deteriorated to being underneath 50%, and we are not even close to contrarian zone. So once again, this is a bearish indication. If we take a look at stocks trading above their 50 SMA in the S&P 500, it is closer to the contrarian zone, but once again would imply some more room to fall before we ultimately get down into those levels where we can think about being severely oversold enough to try to capture more of a dead cat bounce. Both, or all three of these things really do strike me as being more bearish than bullish. Something that's interesting though is taking a look at the equal weight S&P 500. It's already sitting on the lows of the balance area from December. If this catches a little bit of support, it speaks to the odds of a dead cat bounce here in the regular weighted S&P actually being slightly higher, right? So watching the RSP here around 140. Taking a look at the Dow Industrials versus Transports, this chart and this relationship is really all over the place. I don't entirely know what to make of this, so you can let me know in the comments section what your opinion is, but a big breakdown in industrials is not being confirmed by any stretch of the imagination in transports, right? These lows are these lows. These lows are these lows. We're obviously breaking down underneath all of them in industrials, whereas they're all holding actually in the transports. So you can let me know in the comments section, but I'll continue to use this as really more of a measure of volatility, that things are not completely in sync out there from an underpinnings perspective. Speaking of volatility, here's the VIX, obviously shooting in the upward direction here, but nowhere near the capitulation type bottom reads up around 40. With the continued economic data that's scheduled to come out, I would think that volatility remains extremely elevated into the coming weeks worth of trade. If we take a look at the VVIX, the volatility of the volatility index, the complacency effect worked like a charm. We talked about this in the Wednesday video. Hopefully you watched Wednesday's video. Absolutely exploded to the upside on the Thursday and Friday session. So volatility is here, and it looks like it's here to stay as long as this VVIX is elevated. If we take a look at the volatility futures, still in a contango underneath the zero line, but obviously moving towards backwardation on the Thursday and Friday session. Short-dated volatility, 9-day versus 30-day VIX, obviously already in a backwardation here above the zero line, which speaks to a lot of risk in the present day, which is not necessarily what money managers want to see. Rounding out the broad market with the QQQ, obviously there's not as much impact with the lack of financial companies in the NASDAQ 100, but nonetheless, we did technically break down from a balance range here. We did technically find a lower low, and we also violated the 200 and 50 SMA on the daily time frame. So bears are in control, and we would look for continuation into 281.25, but you have to at least acknowledge the opportunity for the buyers to give us a look below and fail, and then we would target the top end of the range. All of that just goes to say is that because this is the heaviest weighted component, the tech sector in the S&P 500, the opportunity for good things to happen is not necessarily 0%, right? There's some probability that, hey, this can actually turn into a bullish looking chart if we rotate back into the overhead balance range. To keep it simple, just watch to see what side of 289.75 we end up trading on. Next up, we've got IWM Russell 2000 and the small caps. What's going on over here? An absolute train wreck. I did the math. This was a 4 sigma move in the downward direction. This is simply something to observe in the coming weeks worth of trade, not necessarily trade. Would I be a new money short down here on the lows? Absolutely not. But am I trying to catch the falling knife for a dead cat bounce? Absolutely not in the face of a 4 sigma move. Look at this. The weekly expected moves here are not even connected. I don't think we've done a video for the Sunday update where the expected moves are not connected. So nonetheless, this is a nasty move. It is going to be an observation for the coming weeks worth of trade. Obviously has very bearish implications. Even if we do rally, lower highs can be found anywhere underneath 186.75. The chart is screaming risk off, but once again, this is something to observe, not necessarily trade in the coming week. Side-by-side weekly charts, notice that we never made it really above the pivot high on the second go-around. We are below the pivot high now that we've broken down, and we are below the pivot high now that we've broken down. On the SPY, there's the opportunity for a higher low. On the QQQ, there's the opportunity for a weekly higher low. And in the IWM, it's very clear because we have ourselves a support trend line. There's the opportunity for a higher low. The probability of good things happening is not 0%, just like the probability of bad things happening is also not 0%. I want to give you the context context that yes, it has been a very damaging week, but there's still some small opportunity for constructive looks on the weeklies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we'll dive right into Apple. What do we see here? Certainly still sitting in a weekly bull flag consolidation zone, coming into the lows of this flag at 146 roughly. Shorts probably want to position off of a lower high against 151 and then the equal low breakdown of 146 to get into 142. If you're a market bull here and you are evaluating the context of the bull flag, that's fine, but just probably wait for the higher confidence longs above 151, noting that on the most recent move from the bottom up to the top of the prior range, this pullback did not hold that level and it ultimately flushed. So for higher confidence longs, want to recapture 151 in Apple. Next up is Netflix. I think this is a wait and see type chart. I mean, we just made a significant new lower low on the flush of that 311 level. We're not really sitting and respecting that structure. Obviously, we went beneath it. So this is a wait and see. Like, what is the next structure to position for a short up against? Where can we find that lower high? I mean, ideally, it's just underneath 311, but that doesn't really offer a whole lot early on in the coming weeks worth of trade. If the bears are really going to remain in control, it just stays underneath 298. The next target is 280.50, but I think we need more information for a better positional type trade. Next up is Tesla. What's going on with this one? Still breaking down from this as an overhead balance area, but notice that we actually closed above 173. I didn't just draw that in because it's the low of the Thursday session. It's actually extremely important from this interaction back here. Here's an hourly time frame chart. If we zoom in, there's that interaction. Notice that it's keeping prices down, keeping it down, keeping it down, keeping it down. When we break out, there's a substantial reaction there off of 173, and that's where we closed above on the Friday session. I'm not pounding the table for bullish outcomes here, but I would say possibly watch and reevaluate for a lower high underneath 188.50, the overhead range in here. If we poke into 188.50, maybe that's a different story for longs. As we've been saying, the best long overall is still up and over 213, which is obviously not in play early on in the coming weeks worth of trade. If we start to violate 173 and break down underneath the low of Friday, it's all about this gap underneath us. 155 fills down to 146.25. Next up is Google, maintaining the bearish stance on Google. Still nothing really impressive has happened. There's the head and shoulders. We had talked about the breakdown of the 3-day balance lows in here underneath 94. I mean, it's all unfolded in front of our very eyes. So we're sitting on the equal low. You can watch for the equal low breakdown into 85.90s roughly. If you want to be a bit more nuanced and look on an hourly time frame chart, you just want to see continued price acceptance underneath 92 for those bearish outcomes to continue underneath 90, right? If you're not comfortable just shorting this early on, then this is what you want to see to keep it bearish, and then something that does this. Technically, we could afford something that does this, but I really wouldn't want to see it interact with 94 once again in Google. If the bulls are going to be in control, it's got to be a double bottom here above 94 with like some firm price action above that level, obviously not in play early on in the coming weeks based on what took place Thursday and Friday. Next up is Zuckerberg's Zuckerberg's Fanny, his fantasy land. What's going on over here? Here's the balance range. This is obviously where we rejected, breakout on the TikTok news, and we're coming in for a retest. Friday's bar is not all that encouraging for the bulls with that large upper wick failing to stay inside of Friday's range, getting us right back down into this area of support. I think it's worth waiting and seeing how 177.22 resolves. It's tough to be bullish in a look like this, but once again, coming into support on sort of this sequence, I'm not overly convinced that it's just a short right out of the gates. If it does break down on an intraday lower high or something like that, your target on the downside is the top of the gap at 167.75. The better long is just being patient for a move up and over 188.75. Next up is NVIDIA, failing at the move over the earnings range from here. How many times? 1, 2, 3, fourth time is the charm, I suppose, rotating back into the lower balance. But again, I will maintain that I don't want to be bearish on NVIDIA till we actually start cracking into the earnings gap from here, which is underneath 224.50. So I will maintain that stance in this area. I think it's worth scalping back and forth, but the cleaner trades are obviously the break of the highs at 242 or underneath and into the gap zone at 224.50 as we just discussed. Next up, we've got Softy. What's going on with Bill Gates and his plan over here? Once again, this chart, complete lack of clarity to me. Double top technically forming here underneath the neckline. This should be the target. Is it going to break down into this prior area of resistance, which acted as support here? Maybe. This, again, I would stay away from Microsoft. Maybe it's my own issue, but I'm just not seeing this chart with clarity right now. So I'm going to pass on this one. Amazon, last but not least, the mini beast before a couple of trade ideas for you. H pattern obviously unfolding here. Equal low after a lower high. Failed move to recapture the daily 50 SMA, maintaining a bearish stance, looking for the flush of the lows at 90.10. then 87 becomes a target, and then the equal lows at 82 from a weekly perspective off of a big weekly lower high here around that 114 mark. If the bulls are going to make something happen very similar to Google, this must turn into a double bottom, meaning we must get price acceptance above 96.50, which as of the close on Thursday and Friday does not look likely. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all that good stuff YouTube tells us to tell you about. Let's dive into these trade ideas. First up is PG, Procter & Gamble here, consumer staples clearly, and we are looking at a bear flag in the bottom end of an overall balance range. A doubling of the range, if we get the breakdown, brings us into 132.50, which was prior resistance, then turned to support for this most recent leg higher here. The other thing we could say is that this is an inside bar setup on the Friday session, so just watching for a flush of the two equal lows to spur downside outcomes. If you do want to watch this bullish, I would say patience till 141 is breached in the upward direction, but it doesn't strike me as being the primary thought, the primary thesis of this particular chart. Next up is PYPL. Speaking of fintechs blowing up, Silicon Valley, all that stuff, this is just a day trade to watch for if we continue to see pressure in the financial markets, or I should say financial industry rather, looking for a scalp underneath sort of the low of Friday, breaking down underneath this candle. You can see off to the left, we have thin structure. There's a gap from in the past to be filled underneath 72.50, closes down at 71.25. Obviously, that's not a range that you would swing trade for. This is an intraday scalp to try to play off some of the pressure in the financial industry at this moment. If it's going to turn into a double bottom, just like we talked about in Amazon and just like we talked about in Google, it's got to get above the neckline to invalidate that trade thesis. And with all of the hubbub around financials right now, I'm not entirely convinced that that's a highly probable situation early on in the coming weeks worth of trades. So that's what I've got for you in today's session. Hopefully you enjoyed the video or learned something new. If you did, let me know in the comments section or by giving the video a thumbs up. Don't forget to move your clocks forward an hour, daylight saving time, or loss, so to speak. And with that said, I hope to see you on the channel tomorrow morning at 8:30 for the pre-market prep. Everybody have a green trading week.